money, and you can upscale your trading all the way up to $1 million account if you so wish. So check that out there. Obviously, you can also get free access to the ForexAnalytix platform. That's also the secondary link you can see there, where if you come via the Forex Flow website, you can get a 20% discount on joining our chat room and the platform therein. So please take advantage of that. And as Brand says, it is a life changer if you've not got a fortune to trade. Talking about the TFP, Brand's in the thick of it. Right, let's get stuck into the stuff going on today. A little bit of everything going on today at the moment. Looking at markets, a bit messy around the grounds, as we call it. You can see from oil there, a bit on the blip. I'm not too sure why. I don't know if that's the price cap that's kicked in at the moment. I don't know if it's global growth worries coming in. It looks a bit of a strange move in oil, considering we're talking about China reopening and how much that might be a boon for commodities. Could be end of month, end of year, all that stuff coming into effect, positioning ahead of all these central bank meetings and the year end, that sort of thing. So we'll have a little discussion on what's going on there. We'll start in China as well, and talking about the COVID reopening. Beijing now won't require COVID tests to enter public venues. That's for supermarkets, commercial buildings. They won't need to show a negative PCR test. But they will still require negative test results for internet cafes, bars, KTV lounges, which I think is karaoke lounges and TV lounges, indoor gyms and elderly care institutions. So slowly they are letting the stuff ease. The Shanghai Security News had a piece out, a bit of a bank shout, if you like, different opinions from different banks, saying that the latest RRR cut may push the 5-year LPR lower in December. A few arguments for and against in that piece there, but if they have got room from this RRR cut, then we could be getting some further rate cuts, maybe into the end of the year, early next year. Over in Japan, we had some data out and some inflationary data, depending on how you want to look at it. We had some household spending numbers coming in. That was up 1.1% versus 1.5% prior month on month. On the year, 1.2%, versus 1.5% expected. Year on year, 1.2% versus 1% expected. So up on one, down on another. We also had some wage numbers coming out as well, and the overall wages are 1.8% with overtime pay year on year up 7.9%. So the overall wage income in October down a bit from the 2.2% prior, but it is something like the 10th month where wages have increased. But a lot of the press has been pointing out that if you take inflation into account, then real wages year on year are down 2.6% versus down 1.2% prior. So the inflation effect taken account there. A little bit two-way on this one. Wages are still gaining. As I said, some 10 months on the trot, wages have been going up. It's just that inflation is now picking up higher than wages, pushing stuff further into the negative. That may play into next year's wage negotiations that we're expecting to see in the new fiscal year. And Kuroda was out talking about such things as well. He was saying the benefits of easing exceed its costs, and they're aiming for achieving stable inflation with wage gains. He said Japan is likely to see wages rise in next year's wage negotiations, reflecting underlying rise in inflation and a heightening of medium to long-term inflation expectations. So this is I won't call it a strange comment, but he's consistently told us that he expects inflation to drop in 2023. But now he's pointing at wages, saying that it's going to keep underlying inflation perhaps on the upside or supported, and that inflation expectations are rising. It can be a self-fulfilling prophecy, that. So a little bit of a I would say, mixed message from Kuroda there. However, he did stick to his old guns. It's too early to talk about exits from ETFs. And also on last week's comments from another Bank of Japan member on the monetary policy framework, he said it's premature to debate specifics on the framework. And that was in a comment regarding the question about, it was Tamura's comments calling for a review of that framework. Kay, what do you make of these comments, particularly on wages and stuff? It's the rhetoric, isn't it?
I first of all completely, I didn't pay too much attention to it, and then saw the dollar yen come out of the Asia session around the highs, and went like, well, okay, I mean, the dollar yields are still doing a little bit better, so I actually started to buy some, and then reading through all those comments, yeah, it's a bit of a mixed bag. He still talks about stable manner, wages need to follow, and if we look at the real wages, they have been the lowest in 7 years, and that's what I really was banking on for the dollar yen to hold somewhere. But since the opening of the European session, it seems that a lot more people are paying attention, and there's also been a bit of an article out by somebody who is supposed to be close to the Bank of Japan, saying that next year that they may start to widen or abandon YCC. That is what's his name? Takeo Hoshi, an academic with close ties to incumbent central bank policymakers. So I guess that's what the market's been trading this morning. Then because dollar yen really not bouncing, and all the yen crosses have been sold in the European session. Yeah, bit of a strange one. Is he preparing us to see a kind of a bit different wording in the December meeting coming up on the 20th? It is possible. It didn't seem like it at first, but then when we read it four or five times, then all of a sudden it starts to look hawkish.
Yeah. No, exactly. And that's central bankers for you. They speak with forked tongues. Say one thing, mean another. And it's up to us to decipher it. So yeah, it's going to put a bit of pressure on this last December meeting. It could just be a non-event, and they kick the can through to January, pick up the pieces then. But we shall wait and see.
Well, he said they won't change anything. He said repeatedly they will not change anything to monetary policy for as long as he's there. So, which is until the end of March, in theory. But we know he has surprised in the past. But until the end of March, in theory, there should be nothing materially changing in the monetary policy. So
yeah, definitely. It's just, as you say, whether they change the odd word here or there to reflect the rising in inflation and this wage negotiations. You know, it could be simple dropped line of if wages pick up to a significant point, then we would look to change something. Sort of comments. Yeah. I think that's the most we should be looking for the meetings ahead. But that's all to come next year, and in the meantime, we'll see what they say at the December meeting. And while we're on the central bank front, the RBA hiked 25 pips as expected, got their rate up to 3.1%. Expects to increase rates further over the period ahead, but as usual, is not on a preset course. Timing and sizing of hikes are going to be dependent on incoming data, blah, 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 blah. On that front, a further increase in inflation is expected over the months ahead. So no signs of topping out in inflation in Australia. They are putting a number on where they potentially see a peak of around 8%. The full effect of rate hikes is yet to be felt in mortgages, and the labour market remains very tight. The economies continue to grow solidly, and the path to achieving a soft landing remains a narrow one. Stealing some lines from Powell there. Why not just copy and paste rather than write your own stuff out? So the RBA there hiking as expected to continue to hike, and we're looking at 25 pips for now going forward. Over to the UK, Black Friday sales apparently pushed up retail sales by more than 4% in November. But in real terms, it was a large drop because of the inflation factor. And as I think it was the FT reported, Black Friday, Christmas shopping, it was a time, sorry, Black Friday, Christmas shoppers are spending more but buying less, which is a significant thing around a lot of economies now with the heightened inflation. I think it's the positive to take from that is that consumers are still spending, whether they're not getting as much for their money these days is another matter, but the fact they are spending so that retail sales are still looking positive, I think is the big positive to take from the fundamental perspective. It's if we start seeing negative spending and spending contracting, that's when we're going to start facing some real problems and when economies really might start diving and hitting deep recessions. On the inflation front in the UK, grocery inflation fell a pip to 14.6% in the 4 weeks to the 27th of Nov, according to Kantar doing their surveys there. So, yeah, a little 0.1% off the price of bread for us shoppers here in the UK. Doesn't make a damn bit of difference, but it all helps. Over to the ECB. ECB's Lane said more rate hikes are needed, but inflation is close to a peak. The inflation rate next year will go down towards 6.6 to 7%, he says, and he's confident we are likely near an inflation peak. So very confident that we might be near an inflation peak. Again, speaking with forked tongue. ECB's Herodotou says doesn't see a hard landing in the Eurozone economy. No material de-anchoring of inflation expectations. There will be another hike in rate, but we are very near the neutral rate. A lot of ECB members talk about being close to the neutral rate rather than a ceiling, as Fed members do. That's trying to keep a dovish spin on it, if you like, or not letting expectations get too far ahead by putting ceilings on things. So their conversations always usually about, or comments usually always contain neutral rate rather than ceiling levels. Over in Norway, and Norges Central Bank Regional Survey said looking ahead, contacts expect lower activity owing to rapidly rising prices and costs, higher interest rates and a decline in public sector orders. Prospects are at the weakest since January 2029. So a bit of doom and gloom coming out of Norway. And speaking of doom and gloom, Fitch were out with a GDP revision to their forecasts. They now expect world GDP to grow by 1.4% in 2023, and that's revised down from 1.7% in their prior forecast. They lowered their forecast for US growth to 0.2% from 0.5% again for 2023, blaming the pace of monetary policy tightening. They've cut China growth for next year to 4.1% to 4.5%. As the prospects for recovery in house buildings fade. 2022 growth they kept at 2.8%. They also revised up Eurozone growth to 0.2%, a massive 0.2% from minus 0.1% forecast previously. They say the European gas crisis has eased a little, but sharper ECB rate rises will weigh on demand. So good luck getting 0.2% growth next year, you lot in the Eurozone. They also speak about forecasts for some rates. They see the peak rate for the Fed at 5%, ECB at 3%, which was revised up by 100 basis points. They see a peak for the Bank of England at 4.75%. That was raised up by 150 BPs since the previous one. They do not anticipate a pivot to rate cuts until 2024. So that's from those guys. Now, yesterday we also had our old mate Timmy Leaks, Nick Timmeros at the Wall Street Journal, saying that the Fed could pencil in higher interest rates next year while slowing hikes in December, and that wage growth could lead officials to consider raising their policy rate above 5%. I think this is another bit of the ingredient in why dollars rallied a bit over yesterday and today. I'm seeing a lot of chatter about markets having gone too far to the dovish side over Powell and the data, and that perhaps some realization, a bit of waking up that the Fed are going to be hiking and continuing to hike until inflation is under control. So we're playing the boat running a bit, I think, at the moment in the dollar, running from one side to the other. That's also borne out by a story Reuters put up titled, "Will the Fed raise and hold rates? Traders bet they will not." This is according to futures pricing at the moment, which is pricing rates coming down in the latter part of 2023 to around where we are now, 4.25, 4.5. So markets expected rates to go high up to 5, maybe 5.25 in the short term, but to come down fairly quickly, thus not trusting the Fed to keep rates high for that long. It's causing a bit of a bum fight because there are some in the market who are saying that those moves in futures are being overdone. They're a little bit too dovish, which gives room on the other side. Now, also in the mix, which Kay pointed out in the chat room yesterday, was a story from the BIS, or a report from the BIS, saying that foreign exchange swap positions point to over 80 trillion of hidden US dollar debt. And this is reported off the balance sheet. So this is swaps that firms can do. So the effect of a swap is you lend money that you've got and you get another currency back at a set rate, repayable in the future. And what this is basically insinuating is that a lot of firms have borrowed dollars against lending whatever currency off, and it's creating a bit of a build-up in the swaps sizing, balance sheets, and that it may be a struggle for some of these firms to repay dollars. It all smells a bit like the usual dollar shortage stories we get from time to time, especially when financial conditions tighten. And the BIS are pointing out that a lot of this is off registered accounting books, if you know what I mean. So it's not set on main reporting procedures. For example, the DTCC, where options are reported, option expiry is reported. There's also plenty of options that are done OTC, that sort of thing. So there might be a bit of an 80 trillion black hole approaching at some point. That obviously also gets the market, as I say, talking about dollar shortages. People think they're not going to have enough dollars. It can create a bit of a negative spiral. If people have borrowed dollars, they've used them for whatever reason, they then need to repay the swaps. They can have an effect of then going back into the market, borrowing more dollars on another swap to pay the old swap. It can have the effect of digging a hole and using the sol to fill up another hole, if you get my meaning. What do you make of all that, Kay, still, the swap stuff? Is it a bit of a storm in a teacup, or something we should pay attention to?
Still, have you read it, or?
Sorry, I was actually on a call for the last 10 minutes, so I'm really sorry.
Easy excuse. Either he's on a call, either he's surfing.
Mate, they called me from the kids' school. One of my kids I might need to go and pick her up anyway. Sorry. I completely missed everything you said. So what was the thing? And I'm
not repeating myself. No, there was a BIS story.
My dog ate my homework. Yeah, man.
Yeah,
I'm sorry.
I was probably go and read the story in the newsroom because you probably want a bit more than what I can tell you in 30 seconds.
Okay.
So I'll pass it over to Kay.
I mean, first of all, the story is mostly about the non-banks, right? So it's pension funds and people like that. But yeah, this swap story, it's a bit of a scary thing when you start to read it. But then, and it could actually lead to if people need to get more dollars to repay those swaps, etc. But mostly those swap rates have been set from the start, so they pretty much know that how much they will have to repay. The problem is that if the dollar rises from here or so until they have to repay it, then they will have to buy much more expensive dollars because they borrowed cheap dollars and will probably have to repay more expensive dollars than they borrowed at the beginning of the pandemic or so. So, yeah, I mean, we have to know that sovereigns and banks and stuff, they are all like under the scrutiny of the regulators. But yeah, this money may be a bit less. But I don't know. And unless we hear, I haven't listened to the BIS comments themselves, so I only read the Reuters story myself. I think it may have had to do something with yesterday's yields also, or the dollar being a bit stronger. But for the time being, I'll let it in the middle, and we see if there's any more comments coming from. And I would think, like, if there would be comments, there may be comments from central banks also.
Well, it's funny you say that, because we had that comment yesterday from the ECB extending their swap lines between them and other central banks till January 2024. And you don't think it's much when you heard it yesterday, but now you see this BIS thing, you think, oh, you know, it may be a case of 2 + 2 = 5, but the timing of the story and the timing of the ECB line, you know, you can draw a bit of a spider's web between them.
Well, I don't think we should mix up both, because those central bank swap lines, yes, they are created to withstand illiquid situations, but are we linking both right now? I don't know.
I don't think so. I'm
a big call, right?
pointing out more the fact that they both dropped within you know, fairly close together.
Yeah.
Call it tinfoil hat stuff.
Yeah.
But yeah. So yeah, that's something that may start to bubble, and as Kay mentioned, it may have had an effect yesterday in amidst the dollar buying as well. If people think there's a sort of shortage, they go out and buy some dollars. So that's that as well. Also, as I mentioned, the WSJ talking about Fed, you know, going higher, may raise through their ceiling, or indicate they may raise through their ceiling. It's just these small bits of news, and we've been talking about how the dollar may have potentially bottomed coming into the week, and for the moment that seems to be the case, and strengthened by some of the headlines. Now, looking at some of the data that we had yesterday, obviously the ISM was the main number. Wanted to see, was it going to follow manufacturing, and it didn't. The ISM came in fairly strong, actually. Looking at the numbers there, employment was into expansion again, so rising employment there, 51.5 versus the 49.1 prior. New orders a little bit softer, but 0.5 pips isn't going to make much difference. And there you can see the main headline number, 56.5, over 3 pips higher than expected. Prices paid holding up, came down 7 pips, but again holding at some pretty strong levels there. So a bit bucking the trend of what we've seen, certainly from services numbers, PMIs from elsewhere, bucking the trend of what we've seen from manufacturing in the ISM last week. So it's we've got a bit of divergence again between manufacturing and services. Again, strong data has helped to put a little bit of a bid in the dollar as well. Just looking at a couple of other numbers before I hand it over to the guys. White House's Kirby said that coming out of the G20, we are encouraged that diplomatic channels of communications will stay open and could possibly expand with China. Obviously, lots going on there, Taiwan, military drills, everything else going on. That anything that leads to better relations between US and China is good for risk. And going back to oil, apparently oil tankers are stacking up off the coast of Turkey as this new price cap, $60 price cap, kicks in. Turkey officials holding up ships, making sure, checking their paperwork, insurance, and that the cargoes they are carrying conform to the $60 price cap. Also, there's been some news from Ukraine as well, and apparently Ukrainian drones have attacked military bases well inside Russia. I saw a few of these headlines yesterday, and I wasn't sure what the cause was, but apparently now it's they're attacking inside Russia. So that could lead to maybe some escalation in that situation there. Right, as far as I'm concerned, that's all I've got on the news front. Guys, you got any bits and bobs you want to
add? No, not really.
Good.
No.
No,
Sorry, my dog
you,
ate my homework.
You really covered the whole lot, mate. Yeah.
Yeah, no worries. So what do you guys make of this oil situation then? Because is this partly due to the cap news? I mean, it's been coming, so I don't know why the market sold off. Is it global growth worries? You know, as I mentioned at the start, China reopening, you'd think oil will be going up, commodities will be going up, but here we are.
You know what?
$7 off.
My impression is sometimes you just can't explain it. I mean, theoretically, this China news should be positive. And also, we had Tracy Schuchard speaking on F.A.C.E on the interview a couple of days ago, and she was talking about how the market's still tight and it will remain tight. So I don't see any logical explanation. But you know what? The market does what it does. I still think that you know, for choice, if you ask me, I want to be scaling into longs. Having said that, of course, the whole prospect of economic growth slowing, which it is not good. But just the tightness of the market and the you know, potentially China reopening, I think it's going to be a strong force. Why we're down 1.5% today, I have no bloody clue. I really don't. I don't know if Kay has, but I really don't. And sometimes, you know, when I don't understand it, I just, you know, I just say so. And I don't know what it is.
No, I agree with you. I just mentioned it looks a bit like a washing machine market to me at the moment, where everything gets chucked in and spun around, and who knows what happens to it. Go on, Kay. What's your thoughts?
It's exactly that, mate. I think the market tried to trade the China relaxation of measures, and then we also had those OPEC plus meetings, virtual meetings, whatever, and they already said that they wanted to cut production if it continued to go lower, and I think the market bought oil on that as well, and then it's a combination, and now they are just selling it out, I think, and probably already front runners $5 or $6 above the SPR bids, and selling them out again. And that creates, as you say, a complete washing machine effect in this market right now. I'm really not. I'm not getting involved in oil, that's for sure. I may front run the SPRs, but perhaps we should back run them in front instead of front running them and just bid 65 or 66 bucks or so. I don't know. I've got this long-term 60, 70 seems like a bit of an equilibrium zone. So if you want to buy it, I think anywhere within that zone could be where we should start to look at longs again. Yeah, as Stelios was saying. But for the rest, yeah, it's try to buy it. If it doesn't work, sell it out again and look at something else.
Yeah, I'm just looking at C here, which put a comment in about, are you talking about the SPR of the US? There was an odd comment about that, but I haven't seen anything big on the SPR. We're talking about the US releasing more. I know there was a comment saying that they had plenty of room to do so if needed, but didn't sound like there's anything concrete coming. So C. Harewood, if you want to embellish on that a bit, please do so in the chat, and we'll take a look at that, no doubt. But yeah, as far as oil goes, got to be looking down towards his $70 mark. I think there's going to be a lot of buyers coming in down there, which also sets up the prospect that someone intends to take those buyers to the cleaner, and any front runners, bidden front runners, let's call them that. So be careful, it could get a bit messy down here. I know we joke about parking up 10 cents ahead of bid and bid at, you know, from the 70s, 65s. But it's a bit more serious than that. If we find that a lot of people are buying into that purely on a front running basis, that potentially puts a big red target on their backs. So just be careful if you are thinking that way. As Kay says, if you're going to go for something like that, anything like that, keep it small, keep it tight, know where you're wrong, don't lose too much if it does go against you. Obviously, we're seeing dollar CAD on the up on the back of oil falling. So creeping up to levels we've seen previously. Let's get into a bit of a shorter term. There we go. So coming up to levels seen, the highs seen in November, late November. So can we get a move up all the way? This is coming again when we've seen decent Canadian data. So it's pretty much, you can see that this one's on the oil bus at the moment. Obviously, maybe a bit of dollar strength in there, given what we've seen elsewhere today. I think if you're going to get up, 37s perhaps, then maybe we would be looking at shorts. Obviously, 38s is going to be a bit juicy as far as I'm concerned, depending again on what the driver is there. But from here, we're looking up, we're looking down. It looks to be we're playing 34, 36 and a half at the moment, the range. That's going to be your marker, at least for the short term. I'll look at Aussie dollar. I'll leave K dollar yen today.
And I want to talk about price action as well. Whenever you're done, I'll just
you've got a
couple of comments.
Oh,
sorry,
cool. You've got something to talk about now, have you? You found your homework.
Anyway, when you're done, let me know.
Yeah, cool, mate. Cool. So Aussie dollar, look, a rate hike, and Aussie dollar's come off. We did get another little knock up towards that late yesterday, that 138 area, 138.50, but it's all been downhill since the RBA. We are testing this short-term trend line, which I had in more as a reference point rather than actually something I'm looking to trade. But it's looking to be a bit of a marker. There is still a bit of a support zone down here in the 66, 60, 80 area. Keep an eye on that. A bit of an S&R level around about 67. I'm still long, obviously, while this pattern maintains in seeing these higher lows. That keeps the rally that we saw from the middle of November firmly in place, and perhaps then we'll see a move up to the highs. I no doubt someone's going to point out that if we get a move up, I'll tell you what, I bet Blake points his out on the face later. He points out if we get a move up to 67.80, it potentially sets up a head and shoulders. Can you get double head and shoulders, Kay?
How would I know?
Double head and shoulders? What is that?
Well, look, you got two shoulders here, then a head, then we might get two shoulders over there, and then bat wings. I'm going to call them bat wings. Look at that. It looks like Batman building.
Or rugby player head and shoulders.
Anyway, I think, as I say, while we're holding this trend at the moment, it keeps the upside in play, but I want to see this 68.50 and that fib broken to give us a decent potential next leg up in Aussie dollar. All right, Stel, what do you got for us, mate?
I just wanted to talk about just the price action, not an instrument in particular, but just what we saw yesterday, because we talked about it this time yesterday when the market was kind of flat, and I was saying, and I think you guys were saying as well, that the risk is now, the market having done what it's done over the past couple of weeks, the risk is now for us to have a little correction leg lower in risk. And remember, I was talking about it here. I said, I think, if that happens, we're going to see a little bit of a spike, but a rise in yields, a rise in dollar, a sell-off in risk. And it's exactly what we got yesterday. And why is that? Well, we have in 2 weeks' time, or is it? It is 2 weeks. No, it's under 2 weeks. I can't remember the date exactly, but we do have 1 week's time. We have the Fed, and we are pricing 50 for the next meeting, and the peak in rates being another 50 after that, which the Fed could easily. Well, they're going to hike 50. I think that's a given. Anything else is going to be a huge surprise. But they could easily guide and say that we're going to stay. We're going to keep hiking, and suggest they're going to hike more than 50 overall after that, and that they're going to stay on that peak rate for longer, because the market, remember, it's pricing 50 basis points of cuts within 6 months after that. So after the peak. So this is the risk right now. Do I think that's going to play out? Do I think they're going to stop hiking and then cut relatively quickly? Yes, it could happen. But I think the market is probably going to look back at what's priced in and say, hold up, this is wrong. You know, they're probably going to be on hold for a little bit longer, and then reprice accordingly. And obviously rates higher for longer is not good for risk. So I think this is the risk we're going to have going into the Fed meeting next week, and probably going into year end. So I think that you know, with the move that we saw in yields, which was very strong, lower, a kind of corrective rally now, a relief rally, is more than welcome, and it's I think it's overdue. And if you look at DSI, if you look at positioning sentiment, they've gone quite bearish. They're still quite bearish in stocks and bonds. So and the dollar as well, you know, is still bearish on the dollar. I have to check the DSI. Hold on, actually, let me just pull it up and see where that is.
Yeah, while you're doing that, mate, I would say that, you know, the move in yield doesn't look reflective of what we've seen in the dollar, though. You know, just moving up from, you know, just under 3.5 to touching 3.6.
Yes, you are right. It's a small move.
Yeah.
It's a small move compared to the dollar, but yeah, you're absolutely right. So it's in the 30s. The DSI is in the 30s for a bond, so it's not.
Do you want to show that quickly, just so people know what it is you're talking about and
yeah,
what the DSI is?
Let me open it up.
This is another one of the tools that we offer on the ForexAnalytix platform.
We offer it every now and then. It's not something we show every single day, but it is. It is there. Continue. So this is an index basically where 100 is ultra bullish and 0 is ultra bearish. I don't think I've ever seen a 0. But look, you know, bonds are in T-notes, T-bonds 37.42. More importantly, Nasdaq 25. S&P 33. So these are not extreme levels, but they are bearish. So it's something you need to keep an eye on. And I think that sentiment had become quite bearish. So a relief rally wouldn't be surprising. And look, it came only a few hours after we talked about it. And as I said before, I think going into the Fed, market is going to realize that yes, Powell confirmed the drop in the rate of rate hikes, but it could easily guide higher. And you know, inflation is dropping, yes, but it's not yet dropping to let's say acceptable, not acceptable levels. We're a mile away from that, but you know, we've seen inflation go from 10.7, what was it, to 10. You know, it's still very high, but it's dropping. I remain of the opinion that early 2023, February, March in particular, I think we're going to start seeing a big drop in inflation, and that's going to make this central bank's job a lot easier. It's going to make it a lot easier for them to guide in a more dovish way and say, yeah, we're close to the finishing post, basically. Yeah. And look at the precious metals as well. You know, they were gold, silver was in the 80s. Now it's dropped back. They're probably going to drop back a little bit more. So you know, all these things you look at to gauge sentiment and positioning, and you know, you take those into consideration when you try to decide what you do with the trades.
Yeah, fantastic, mate. Thank you very much. Kate, do you want to take over the screens for a little bit?
Yeah, just a couple of things. Where am I? First of all, Charlie's daily question about Aussie Kiwi. Charlie, are you in our ForexAnalytix community? Because we talk about Aussie Kiwi there every day, every few hours even. But just to update what I said yesterday, I had this support in the mid 105s, and then the trendline support here around 105.20, which could be a bit of a panic level to get out. But we went to tag this 105.60s, and now we are trying to set a rebound in motion. 106.65 is the first level that we should be looking at, and the rebound took us so far to 106.60ish. So it seems the market is looking at this as well. So this is your initial range now for the time being. We need to get above this to start to get creep back into the 107s. That for the short term, and I'd say if we break sub 105.20, I don't think is very good news for this pair. But in the meantime, it seems to have it ought to be in an attempt to put in a bottom around this in those mid 105s. So this is the one that I'm going to keep an eye on. I did not put an order in there, so I might have missed the lows, but okay, tomorrow the market will still be there, and I'll see what happens if we start to break above 106.65 again. That for the Aussie Kiwi. Aussie in itself, we held on the RBA, we held this 66, what is it, 90 zone, call it 66, 90 zone. That's going to be the support going into the US session, in my opinion. And then top sides, the first level, we are not too far away, around 67.40, then have a look at 67, 60, 70. If that starts to go, then there's a fair chance we get a move back up to the recent highs. But this afternoon's US session, I'm really I don't have too much of a strong view right here and now. The dollar seems a bit mixed, especially actually on the defensive this morning. The euro is stable around 105. Cable has been well, sterling as a currency has been a bit weaker. I think there's been a lot of sterling yen sold, or at least a lot of yen crosses have been sold today. This morning in the European session, because we went to and I'll show the yen crosses a bit later. Well, in a few minutes. Cable, interesting around here. We've got this 200 DMA 121.35, but before that we have the broken trend line which we retested. That comes in around 121.5. It's also the low around there. The lows after the NFPs. So this 121.35.50 zone is going to be the support to watch on the cable. If it goes back below, then I think there may be a case of starting to correct the latest rally up to the mid 123 highs. Call it 120.60, 119.90, just below 120. If we break this zone, that's those are possible levels to have a look at. And then we're talking about this trend line support here in the 119.60s. For as long as this hold though, there's a small level in the around 122.20. So that needs to be respected, because we have, as you can see, we have tested it a couple of times since yesterday, and there are offers around there. It's also a bit the prior bounce low. So respect the 122.20s as well on the cable. Then moving over to the yen crosses. As we can see, we started the day in Asia on a really big note, but since then we've already come off like 100 points on the sterling yen. I'd keep an eye on what's happening just around the 166, the figure. We are about 35 points away if it continues. On the, just hold on one sec. On the other yen pairs. So first of all, look at a quick look at the dollar yen. Dollar yen, this trend line break, and perhaps yesterday and overnight especially, we broke back above, and now we're coming to rest on it. It's around 136.65. There's not a bit of support around 136.20, 25 in my opinion. But the rejection may have to do with what Kuroda has been saying, but also if you look at oil, if energy prices and the prices of energy come down, that is also another aspect of putting a bid under the yen. I tried to trade off it, so I'm a little long just above, just got stopped on a part of it. that deteriorates my average a bit. I'm going to keep a close eye on this line, whether we can get back above to get back in it. But we have to take into account all those fundamentals, what Kuroda said, what oil is doing. So I may just keep a small part of it, and if it goes up 136.20, say adios to this one. Euro yen. If you look at this little trend line, went to tag it in Asia, and as soon as Europe arrived, same thing, around 143.90, 144 the figure, and we came down 50, 60 points lower now. So the same thing happening on all the end pairs. Keep an eye on those for the afternoon, I would say. If we've seen a top, there's a possibility we can get back into the mid 142s on the euro yen in the short term. But if 144 starts to give way, there may be another big figure on the top side. And the same happens in Aussie yen. Look at this trend line, how many times we've already tagged it. Last time we went up there was end of the month. Since then, it has come off due to the Aussie weakness rather than anything. This one looks a bit fragile. Too many moves up and down, but it's around 92.05, 92.20 here, 92.20 there. So keep an eye on 92.20 on the Aussie yen. If we fail there again, we could be on our way to 90 the figure. Why not? CAD yen, and then somebody asked about the Canadian crosses. Well, Canada yen, since oil is coming off, it's not looking very fresh, is it? So there's a risk we are going to test this 98.5 at one stage. It's also the springboard for the last move higher. So I'd say if we get more failures, watch what happens around 98.5. On the top side, we need to get back above 101.5 to start going again. So 101.5 is your level on the top side for this Canada yen. Euro CAD, it's really, euro is doing pretty well on all the crosses, I must say. I was monitoring this 142.55, 142.65 on euro CAD. But we are already trading above 143, and I don't really see too much above here that is going to hold it from rallying even more. The best thing in EuroCAD, if you're looking at the other side, if you think that oil is going to stabilize sooner rather than later, look at this 142.55, 65. If you get a failure of it, then it's perhaps a better idea to try a short again. In the meantime, I'm just going to keep my hands off it. Bank of Canada, tomorrow, yeah, they're expected to raise another 50, but it could be that they only do 25. It just could be. So be a tad careful if you trade Canada into tomorrow. Of course, the combination of Bank of Canada and oil is could be deadly for the Canada. Sarab, isn't EuroCAD too extended? What's extended? The market is doing what it does. It could be extended, but then if it's extended here, then we need to get back below this 142.55, 65, in my opinion. As long as you don't go back below there, are you going to stand in the way of things? We can always have a lucky shot and catch the top, but I'm not really tempted to do much in that right now. Silver in between the goalposts, 22.20 has been the low yesterday. 22.55, we are around there. We're a bit in no man's land. I think what's happening in China is going to be of a guide for us there. And then, of course, what's happening to the dollar. But for silver to really make headway, as we've been saying already many times, it's an industrial metal. So keep a close eye on what's happening in the real in the economies, in the global economy. But anyway, I think in regards to what we have seen the last moves, somewhere 20 to 2022 may be good enough to catch a small knife. I'm not adding to my core for now, but I'm just rebuilding what I've sold earlier the last week. I'm just rebuilding to get back to my core, and I may wait to really add if we get a move back down or a sustained move above here. And with that, Ryan, to Swiss yen, if anyone of you guys, Ryan or still wants to cover Swiss yen, I'm never looking at Swiss yen. You can. I mean, no, for me, if I'm trading Swiss, I rather trade Euro Swiss because that's the purest of the process, or sometimes dollar Swiss. But Swiss yen it's coming off, but yeah, I'm really not watching it.
Yeah, well, give us your thoughts on it, Anis. You know, what are you looking at? As Kay mentioned, it's not one we look at a lot. I'll throw the chart up quickly. There are absolutely no techers on it whatsoever, bar the moving averages, of which we're capping at the 100 DMA right now. I've not been looking at the Swiss too much of late at all, really. It's sort of taken a back seat in what's going on elsewhere. We obviously do have the S&B coming up, so that's going to be a consideration, their last quarterly meeting of the year. Also in that big week next week coming up. Let's have a look what they expected to do. It's probabilities looking at 72.5% for a 50 pip hike from the S&B. The other pricing is 25 pip hike for the balance. So yeah, keep an eye on there, what they do there. Again, I think we could be on for a larger than expected hike. I think there's a chance they go for a big one, but let's see what they say and do next week. On the other side, Bank of Canada, as we're talking about, that's tomorrow as well. A 25 pip hike is got a probability of 71.5%. A 50 is 28.5% chance, according to those metrics there. But yeah, on Swiss yen, give us something that you're looking at, Anis. What are your views on it? Are you looking one side, the other side? Give us a bit of insight, and then maybe we can delve into that a bit deeper. Still, you got any other bits you want to look at before I carry on having a quick look around?
Not really, no. I'm gonna take a few. Let me look at the schedule. Hold on a second. I think on Thursday, tomorrow or Thursday, I'm going to show some charts and stuff because things are moving a little bit, but I don't have anything today to of a note to show. So yeah,
maybe save that for Thursday because I'm going to be off Thursday. So
okay, Thursday's done then.
And I just wanted to remind people, if you have many questions as well, and if you're looking for help of other people, it's always a good thing. You can join the community, the ForexAnalytix, because a lot of people are looking at a lot of stuff in there, more than what we can cover in our daily shows. So please come and join us. And there's always going to be someone in the community who has a pretty good view and ideas on how certain pairs or certain instruments should or can trade.
Yeah, thanks, mate. This is looking for a break, retest, and push down to the 200 DMA on that chart. Well, yeah, nice goalposts you've got there to plan against. You know where you're wrong at the moment, above that 100 DMA. That's where you're likely to be wrong. If you are trading the moving averages, then, you know, depending on your purse strings, a stop above the 55 may be what you need to be looking at. But if we hold here, you need to get through this low first, down here at the 142.80s, get through that before you got any chance of getting down to the 200. And that's a bit of a level there. Let's put some tickers on it while we're here. We got a bit of a level here. As you can see, it was a former resistance area. Called it 143s, had the break, came in as support, pretty much came in as support again. So you got your picture built there. You need to get above that 100 for an upside. If we get below this 143s, 142.80s, then you might get your 200 DMA there. And then if you want to look for longs off that, that's what you need to do. Keep it simple, stupid. As we like to say, the KISS formula, applicable to all traders, including us long in the tooth with it. I've put the link up to the chat room there if you guys and girls want to check it out. As I say, 20% discount if you come via Forex Flow. That's for the lifetime of your subscription. One other thing I just wanted to highlight, keeping a close eye on $1, and look where it's run into trouble as expected, into the 7 area. A couple of attempts up there, held. That's where the door is locked for now at that 7. I'm not touching at the moment. As I say, I think some of these moves are a bit washing machine. I don't have a good grip understanding on what these moves are doing in the short term. As I said, I did expect a bit of a dollar bounce, considering we saw some of those lows in pairs like dollar yen, but where it goes from here, I don't know. But if you're trading this one off the 7 level, as been mentioned, you're going to be looking a bit wrong if it gets above 702, 703s. That's where you could be in trouble. But while it holds, and that keeps a downside in play. I've still got a level down at 690.91. We've also got this level building now in the 93s, so keep an eye on that one there. As far as that goes, unless you guys and girls have got anything in particular, we shall call that a day. If you do, save up your questions, save them for Thursday because I'm off, and you can throw them all at Stel. Make up for his lack of his lack of homework today. So get your questions stacked up for Thursday. Stellar Thursday, we're going to call it.
All right, guys.
Yeah, I'll do the first 2 minutes of news rundown. Then leave it off to Stell and just leave.
Fine by me. Thank you, Ryan. Thank you, Kay. Thank you, everybody.
Thanks, guys. Have a good day, everybody.
Have a great day, everyone. Cheers. Thank you.